Sikshayati, platform for eminent authors, engaging teachers, successful students. To know more, email. Contingent assets and contingent liability. The term contingent means circumstantial, incidental, conditional, etc., meaning something not sure to happen. According to AS4, the term contingent is used for those items whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the enterprise. For example, a tax liability under legal dispute pending in a court of law, for a claim for damages with insurance company, etc. Contingent asset. As per AS29, contingent asset is possible asset that arises from past events, the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of enterprise. Recognition of contingent asset. An enterprise should not recognize a contingent asset since this may result in the recognition of income that may not be realized. However, when the realization of income is virtually certain, then the related asset is not a contingent asset and its recognition is appropriate. Disclosure of contingent asset. A contingent asset is not disclosed in the financial statement. Contingent asset may be disclosed in the report of approving authority, that is board of directors in case of company, only when an inflow of income is probable. Contingent liability. As per AS29, a contingent liability is a possible obligation that arises from past events to be confirmed on result of uncertain events not in control of the enterprise. A contingent liability is a possible obligation that arises from past events and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the enterprise. The contingent liability may be a present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or a reliable estimate of the amount of the obligation cannot be made. So to say, contingent liability also arises from unexpected or unplanned activity which gives rise to the possibility of an outflow of resources embodying economic benefits, for example, possible fines and penalties payable to government. Recognition of contingent liability. An enterprise should not recognize contingent liability, but it should be disclosed. Disclosure of contingent liability. If there is a possibility of an outflow of resources resulting economic benefits is probable, an enterprise should disclose for each class of contingent liability at the balance sheet date, giving a brief description of the nature of the contingent liability as a footnote at the bottom of the balance sheet. Thank you for watching the video. Kindly write your comments. Click on the red subscribe button at the bottom of the video to get more details and free ebook. Email us.